Squirrel Macro, the pod, and Happy New Year. This is our usual companion to the weekly newsletter, back after a 1-week hiatus for the holidays. Very excited as this week we're launching a new product, the BUSHY. Are you not intrigued? Anyway, I'm coming to you on the morning of Monday the 6th of January Melbourne time. Quick reminder, as ever, to make sure you get the show notes for charts and links, and if you don't have them, fix that right now by signing up for free at blindsquirrelmacro.com. First up, everything in this podcast is for educational and entertainment purposes only and is categorically not investment advice. Before making any investment decisions, for heaven's sakes, don't listen to a cartoon rodent, talk to a real financial advisor. So, those of you on my mailing list will know, as I flagged it last week, that 2025 brings a fresh new product to Blind Squirrel Macro. The Squirrel's BUSHY portfolio is a long-only multi-asset product comprised of US-listed exchange-traded funds, or ETFs. The goal of this portfolio is to be a low-turnover, easy-to-execute expression of the rodent's core macro and thematic views. More on that later, after a first week of Q1 2025, we need to take stock of where we are in the world of macro. So, in anticipation of the inauguration of the tariff president on January the 20th, bullish positioning has driven US dollar FX crosses aggressively higher in the 2 months since the election of a leader whose core electoral economic policy messages were decidedly dollar negative. Yet FX markets would appear to be priced up for the maximum tariff bomb angst. Is history about to rhyme? Because if you recall last time, and there's a good chart in the notes, that the dollar sold off pretty quickly after an initial surge in 2016. In US equities, Wall Street strategists appear confident that the S&P 500 will tack on yet another 10 to 15% positive return for 2025. Interestingly, the most bearish price target on the street comes from Cantor Fitzgerald, the firm that is led by Howard Lutnick, the incoming Secretary of Commerce. Now that would be ironic. The US Treasury market has had a pretty rough month after the initial post-election view, perhaps misplaced, that the new administration would be staffed with fiscal hawks. Regular readers will be familiar with the Squirrel's bearish view on the long bond. This rodent certainly sees higher yields in the medium term. However, with such extreme short positioning in the bond market, some kind of aggressive rally, i.e. higher bonds, lower yields, would not be a surprise to me in early 2025. At the policy rate end of the curve, the market continues its year-long rally of hard, soft, no-landing tennis. This rodent struggles to see a 2025 in which some kind of growth scare does not build a few rate cuts back into market expectations from the current one and change currently priced. Could the construction jobs that Chase Taylor and Warren Pies focused on so intently be the early warning signal for that wobble? The Squirrel now owns a few SOFA futures just in case. My friends, the Shrub and Palo Macro, have been chronicling the eruption of speculation that's returned to the market since the election. Time to check back in on the trademarked YOLO portfolio, my new risk parity portfolio minus the meme coins for your average financial nihilist. I created that in December. YOLO is still up a cool 100% since the election. Nothing to see here. Again, a chart in the notes. Finally, and I love this as it feeds into my existing biases, but some of the market commentators that I respect the most are making pretty compelling cases for the end of exceptionalism for the US cap-weighted equity indices. Kevin Muir, already an avowed Canadian Mag 7 grizzly bear, makes some terrific inside baseball comments about the compilation methodology at the Russell indices. Now, he almost certainly thinks that the Squirrel's a stalker, but AQR's Cliff Asness has written a memo describing an asset allocator's imaginary 2035 post-mortem or mea culpa. It's an utter gem. Team Saddlebags should be sweating. The Squirrel may also need to go and see the chiropractor after nodding so vigorously while reading Eric Renander's piece on the South Africanization of the US. He sure took some heat in his comments section, but he puts together a very compelling thesis. And finally, I may not agree with Russell Napier on all matters China related, but his call to own global equities x the S&P 500 is poetically articulated on a video that I've shared in the show notes. Now, the only word that could accurately describe the performance of international equities versus US equities in the years since the Euro banking crisis is abysmal. I put a chart in the notes that plots the relative performance of the MSCI EFA, that's Global ex-US Index, and the MSCI Emerging Markets Index versus the Russell 1000 Index of US equities. The charts are so down and to the right that they'd make for a challenging ski run. However, if you zoom in, you can clearly see periodic attempts at international optimism over the year-end to Q1 time periods. There is some Groundhog Day risk here, but the fact of the matter is that owners of US equities, many of them foreign, are no longer being properly compensated in terms of risk premium. Yes, I get that many have called for a rotation out of US equities, especially at this time of year, for a while. However, as we enter 2025, the risk premium on offer for owning US equities is now effectively zero. The BUSHY portfolio will indeed be anchoring on opportunities that are further afield, but first I need to explain the name. In your favourite rodent's distant past, some time was spent creating structured financial products for the corporate and institutional clients of the squirrel's various employers. I hasten to add that I'm not talking about the kind of toxic waste described in Frank Portnoy's excellent book Fiasco, such as levered bets on the Mexican peso FX rate dressed up as AAA rated bonds so that the wrong people, think municipal treasurers like that Citron chap at Orange County, could own them. Anyway, the derivative world loves a good acronym. It probably needs to get out a bit more. Fiasco itself was the name for Morgan Stanley's annual client junket, the fixed income annual sporting clays outing. There was also an infantile goal of many junior structured product structurer to trick their boss one day into pitching a permanent equity net interest swap to a client. I shall not be spelling that one out for you. Most of the time, these acronyms were frankly pretty laboured to ensure that the product content didn't get in the way of a catchy marketing name. And with that, I give you, and this may not work as well on audio as you can't see the letters that I've bolded, the Blind Squirrel's Ultimate Strategic Holdings with some yield portfolio, the BUSHY portfolio to its friends. There'll also be some tail hedges. Get it? BUSHY's initial long-only portfolio will be made up of approximately 30 US-listed ETFs, reflecting the core medium to long-term views and themes from my research. I will, of course, continue to publish separate Acorn thematic trade ideas. The portfolio's ETFs will range from simple country and region and sector index-based products to the more sophisticated derivative-based strategies that recent SEC rule changes have allowed to be placed within ETF wrappers. There will also be a suite of suggested and tracked hedges for readers that may want to dampen exposure to some of the portfolio's larger asset allocation calls, such as longer-term US dollar weakness and an end to US large-cap tech or Mag 7 relative market outperformance. The portfolio will be tracked in a COIFIN model portfolio, which can be shared in real time with subscribers, allowing users a detailed review of sector, factor, and geographical exposures. I'll report on the allocation changes in real time and conduct a full portfolio review once a quarter. Now, many of the launch constituents of BUSHY have been created in the past 12 to 18 months with those rule changes I referred to. As such, I constructed a legacy version of the product, replacing some of the launch constituents with more established ETFs in order to create a, imperfect I grant, longer-term track record for the portfolio. Given BUSHY Legacy's significant underweight position in market cap weighted US equities, underperformance versus a classic big retirement portfolio over the past 5 years is hardly surprising. However, BUSHY Legacy still compounded at 5.6% versus the 7.16% 5-year CAGR for the Vanguard product. Pretty remarkable given its massive underweight in what has done best during that period. There's a 5-year relative performance chart in the notes. There's also a drawdown profile in there versus that classic retirement portfolio benchmark. While few portfolios were spared hair-raising drops in the COVID panic of March 2020, the modelled drawdown profile of the legacy BUSHY portfolio stacks up very favourably versus the big retirement option. I'm really excited about this launch. In section 2 of the letter for paid subscribers this week, I did a deep dive on the structuring and philosophy behind BUSHY. Hopefully this is a trigger for some more of you to support my work and join the Squirrel's Circle of Trust by becoming a paying subscriber. I can't think of a better New Year's resolution. Find out more about that at blindsquirrelmacro.com. You can also follow me on Twitter @SquirrelMacro and on Blue Sky @BlindSquirrel. Thanks again for listening. Please do spread the word. Happy New Year. Squirrel out.